Jesse, thank you so much for stopping by. I'm a huge fan of your Twitter, your blog at thefelderreport.com. I was telling you before the call how much I use your Twitter. It's just so valuable getting all the important articles that you look at summarized on Twitter. Very helpful.
Yeah, Twitter's been an incredible resource for me. Not to, I follow like 100 accounts or something like that. And they're just, I try not to miss a single tweet because I find, just the information sharing there's, to be so valuable. It's incredible that it's free.
Yeah, no, it definitely is. And again, a huge fan of your Twitter in particular. Like, it's just so valuable. And your blog. So with the first one I want to talk about, actually, the first question is related to your most recent blog post. You literally just uploaded it on June 9th. And it's the markets have bought the Fed's transitory narrative hook, line, and sinker regarding inflation. Can you just give us your thoughts on that and whether or not you believe inflation will be transitory?
Yeah, I think, a lot of people have come to the conclusion that, with inflation numbers coming in hotter than expected, April CPI was much higher than expected, and May is expected to come in even higher than that. The markets, there's a consensus out there that inflation is back. And if there is, it's not reflected in the markets. I basically in that post just featured a few tweets from different accounts that I found valuable. One of them is Michael Sarwa, I think, and he basically shows that with the current level of inflation, interest rates are way too low. Typically where inflation is, interest rates should be, like twice as high as they are today. You can also look at just within the stock market, I think is maybe even more important to the kind of work that I do. You look at the stocks that are typically the best things to own in an inflationary environment. GMO put this research out recently that metals, metals and mining, and energy, traditional energy sector are typically the best areas within the stock market to kind of focus your attention during an inflationary environment. And those sectors are the cheapest. They trade at the biggest discount to the broader market than they ever have. And at the same time, the longest duration segment of this stock market, I think they just use the quintile. The quintile most highly correlated to interest rates is the most overvalued it's ever been in history. That was Richard Bernstein and Associates, I think, that put that out. So the stock market is absolute. The bond market's pricing in inflation, falling back down relatively quickly. And the stock market is absolutely pricing in a disinflationary environment in the face of all these rising inflationary pressures. So, to me, all that suggests is that if inflationary pressures do come back in, okay, well, that was priced in, market doesn't move the market very much. But if inflation proves more sustainable than the markets and the Fed wants us to believe, then that could set the stage for some type of a repricing to reflect that.
Yeah, and that's what I wanted to ask you about because, again, like you're saying, the narrative is that inflation will be transitory. You have Kathy Wood, who does probably talk her book on this, saying that companies are going to be stockpiling all this inventory. There's going to be a rush for commodities, but then when they realize that the economy is kind of stagnating more than they thought, they're going to have all this stockpiled inventory, and that's going to cause a collapse in commodity prices. And then there's also the deflationary fears like globalization, loss of jobs because of that, AI, that we've had for a while. So what is your take on whether or not we may be in a transitory inflationary environment, back to our deflationary ways, or if it will be something bigger?
Well, it's a huge question, and there's so many different moving parts. But I would just say, first, I think Kathy probably better than anybody should understand the demands that are going to be placed on copper production in order to meet this green energy revolution, just to produce, the batteries and things for electric vehicles, for solar panels and wind. All this stuff. is going to be copper is really the only metal, the most effective metal at, electricity transmission. And so it's going to be hugely intensive on copper. And copper prices have just screamed higher. So I think to expect that, there's Glencore, one of the biggest miners of copper, came out and said, we need, essentially 4 or 5 more Glencores producing that much copper to meet the future demands, for this green energy revolution. So, but specifically to the question of, is inflation sustainable? I think you have to differentiate between cyclical and secular, inflationary forces. Obviously, there's cyclical forces. We had a huge disinflationary force, which was the pandemic and lockdowns and all that kind of stuff, which I guess was disinflationary in some respects, inflationary in others, because, people stopped, traveling and all those things. And so prices there dropped, but a lot more eating at home. And so food prices and things went up. But the reopening of the economy is obviously kind of a cyclical inflationary force. That is something we haven't seen in the past, where basically you shut down an economy and then reopen it all at once. It creates a lot of the problems and things that we're seeing right now. But I'm more interested in kind of the secular forces. I think if you look at what are the big disinflationary trends over the past 40 years. You look at, probably globalization, to me would be top of my list, being able to offshore labor and lower your cost of production by, moving it overseas. To a great extent, right, we've seen that play out about as far as it can. And actually, there's a consensus developing now that it's played out too far. That when you outsource things that are a matter of national security, like, we couldn't source PP&E, during the pandemic. That's a problem. And now we're realizing semiconductor shortages. A lot of that is because we outsource production overseas and we don't have the manufacturing capability to meet, demands. And so I think we see the Biden administration talking now about, we need to get a little more control over our supply chains, and we need to bring home a lot of that production. That would be a reversal of this massive disinflationary force, because obviously bringing manufacturing back to the United States is raising the cost of production and raising prices. So yes, it may reduce a lot of the supply chain disruptions that we're seeing, but it raises the cost of production at the same time. So, I mean, there's a possibility that globalization could be now shifting to deglobalization or a reshoring of production and labor, which would mark at least the end of that disinflationary force. There's also demographics, and I think that's probably the other big one with, the offshoring trend, represented a huge surge in the supply of labor. All of a sudden, it wasn't just Americans that could produce all this stuff, it was anybody in the world. And so that, huge surge in supply of labor pushed down a lot of labor costs. At the same time, the baby boomers were coming into the workforce and into their peak earning years in the 2000s and things. And, now the baby boomers are retiring. And I think we saw that kind of exacerbated during the pandemic, where a lot of baby boomers saw their retirement accounts surge as a result of the stock market and said, hey, this is probably a good time for me to get out of, to finally retire. And a lot of them weren't able to after the financial crisis, just because of what happened to their retirement accounts then, what happened to incomes and all that kind of stuff. And because we saw the opposite this time, we saw a lot of those boomers retire. So that huge surge in supply of labor, on the part of the boomers, is now shrinking and shifting our dependency ratio. That's probably the most important thing, where the dependency ratio is rising. So essentially, you take the number of dependents in an economy or in a population compared to the number of the income earning share of that population. And there was an interesting study, I think it was the IMF put out, where they showed that a rising dependency ratio is very highly correlated to rising inflation. The only, in countries around the world, the only country where that hasn't held true is Japan. But essentially, when you have a falling dependency ratio, more workers and fewer dependents, that's what we've seen, a disinflationary trend. That's now reversing, where we're seeing the dependency ratio rise. And so demographically speaking too, I think we're seeing, inflationary forces there. Those longer term forces, I think, are what I'm more interested in, because they're going to be, underlying, the cyclical forces and kind of more direct, more kind of indicative of the longer term trend for inflation.
Yeah, that is a great analysis of the labor market and the trends that are going to be driving it, and the shortages. Because right now there obviously is a shortage, I think, for restaurants, right? I'm sure you've heard about that, and there might be a squeeze, right? A big demand for labor, which would totally throw the transitory inflation narrative out the window. So given that, obviously stocks, right, have been vulnerable, including the ARK ETFs, right? We already mentioned Cathie Wood, but what are you seeing in the stock market as far as valuations if inflation isn't transitory?
I mean, one of my favorite quotes is from Warren Buffett: the price you pay determines your rate of return. So pay a high price, you get a low rate of return, and vice versa. And, a valuation metric should be good at representing that dynamic in the market. So I do think that right now, across those types of valuation metrics, whether it's the Q ratio or the Buffett yardstick, or just simple price to sales measures, the stock market has never been as expensive as it is today, which to me tells me long-term returns are probably going to be lower over the next 10 years or so than they've maybe any other 10-year period we've seen in history. Now, that's what's different between today, because you look at past peaks, 1929 and 2000 were the two other times the stock market got nearly as overvalued as it is today. 2000 was one that I lived through and traded through. And what was different then was it was really kind of the overvaluation was relegated to one segment of the market. I mean, a couple of related segments. It wasn't just tech. There were a lot of blue chip stocks too that became extremely overvalued. And I think the difference today is when you look at the median stock, it's really hard to point to there's one segment of the stock market that's overvalued, because even as my friend John Hussman has pointed out, the cheapest decile of the stock market today is more expensive than it's ever been in history. So you don't have, like in 2000, you could really look at, I mean, a lot of the, bank stocks, thrifts, old economy bricks and mortar stocks is kind of how they were referred to during the dot-com mania. A lot of those traded at really cheap valuations. I was buying Washington Mutual at 5 times earnings when it was just a basic, thrift. We take in deposits and loan them out to people in the form of mortgages. It's very hard to find that kind of value in this market. It's not. I'm certainly not a majority of the market, and even the stuff that kind of looks cheap is expensive relative to history, even if it looks cheap relative to the rest of the market today. So I think it's an extremely challenging environment. I think it's definitely more geared towards stock picking. Just, because if you can find things with a margin of safety, I think that's critical today, because general market risk is probably so high. But there's also these segments of the stock market too, like you mentioned, a lot of the Cathie Wood stocks, and a lot of those, it's interesting to me to see a lot of those are down 30, 40, 50% off their highs, whether, looking at like Zoom and Peloton, and a lot of these stocks have benefited from the lockdowns and the stay-at-home trend, are already, in the midst of crashing. We've seen, SPACs, which were another kind of, center of a lot of the manic, trading in the stock market. Seen a lot of those collapse, and SPAC issuance is way down. And so to me, there are a ton of signs that risk appetites in the stock market are potentially waning. And that is a very dangerous thing when you're in the midst of a mania like we are today.
100%. And any rational investor would see that, right? And you have an incredible chart on your website that shows small speculators. So retail speculators are at almost an all-time high. They just blasted through. There is a massive frenzy right now in stocks, and you normally want to fade that, right? But just to play devil's advocate here, because yes, it is the logical conclusion that everything's completely overvalued by every metric. But this is you could argue is a completely different period. Like, we're becoming Japan, where everything's going to be propped up through printed money. We just had the worst depression since the Great Depression. Stocks essentially went straight up. Like, if that couldn't derail the stock market, what will? And can the Fed just keep propping it up?
Yeah, I mean, it's a great question. I would just say, if we are Japan, go look at the Japanese stock market indexes over the last 30, 40 years. It's not a pretty sight. The Nikkei is still down 20, 30% from its peak in 1990. So 30 years plus, you're still down from if you bought it in the early 1990, late 89 peak in that stock market. I would say really yes, that is the number one argument to, why the stock market, can't have another bear market like we've had in the past, is that the Fed just won't allow it. And I absolutely agree that the Fed has been targeting asset prices for over a decade. Ben Bernanke was very clear about that when he was the head of the Fed. He said, we want to try and prop up asset prices to create a wealth effect, which is, try and make people feel wealthier so that they go spend more. So then it's trickle down economics on a monetary level. And it didn't work so great, which is why we're seeing fiscal policy now step in the wake of this last economic, trial. But I think that really the Fed can continue to do what they're doing, which is essentially monetizing fiscal policy, monetizing, the new debt issuance to a great degree. They can do that so long as currency markets will allow them to, which is why I've said for the last, really since the beginning, I think my first market comment I wrote in 2020 to my subscribers was, this is going to be the year to watch the dollar. And 2021 is also the year to watch the dollar, because I think this is why the dollar weakness we've seen recently is really the one reason. It's not the inflation numbers or anything like that. I think it's really the dollar that it's really encouraging the Fed to start talking about tapering. Because if the dollar really rolls over, that's the thing that I believe could take the printing press away from the Fed. If we have inflation starting to take off and it turns out that it's not transitory and the dollar begins to collapse as a result of the, profligacy, at the fiscal and monetary level, that becomes a major problem for the Fed. And they can't afford to just sit back, watch inflation take off and the dollar tank, because that would create I believe an inflationary spiral that would be too much to come back from. And so I think that at some point they may have to turn their attention to protecting the currency. And so it's why I'm watching the dollar like a hawk, because if we break down below this 89 level on the dollar, that might, step up the tapering talk and the tapering, policy much quicker than people would anticipate.
Okay, so that's what would kind of prick the bubble and cause a correction. And you've been, I think, spot on in calling weakness on the dollar over the past few years, actually. And my question is that similar to the 70s where it was out of control inflation, nominal rates were spiking, and they had to come on and put a cap on that and actually raise rates to like 20%? Is it similar to that?
I think so. I mean, I think that in some respects, obviously in others, it's not. I don't think that we can afford higher interest rates today. I think that, that's, you could debate why interest rates are not responding to inflation right now. That could be an interesting discussion. It's all, but it's all really speculation. I don't think we could afford for interest rates to go back up even to, 5% across the curve, because that would be, the interest costs on the debt would rise to such a degree that, people would call into question, essentially our solvency. I mean, we can never really be insolvent as a country because we can print money to pay off our debts. But the more you're forced to print in order to pay it back, the more dollar-based investors are going to get nervous and want to protect against debasement of the currency. And I think we're seeing that right now. I think we've already seen, foreigners in the past year, really since the pandemic, the response to the pandemic began, and the Fed, monetized trillions of dollars in a heartbeat. I think foreigners have begun dumping treasuries massively, and so to me that right there is a shot across the bow to the Fed that you need to be careful about it's this term fiscal dominance that I've used, which is in the past decade until really 2019, the Fed was able to choose whatever types of monetary policy they wanted to try and boost the economy and meet their dual mandate. But I think when fiscal policy takes over, meaning the debt issuance becomes so great, the Fed is forced to monetize it. That to me is the definition of fiscal dominance, and the Fed is no longer an independent entity able to pursue its dual mandate because it's being forced to monetize debt and fiscal spending. And I think I think we've probably already crossed over that line, and the world is beginning to realize this, and that's why I'm paying such close attention to the dollar. I do think that is the main thing to pay attention to right now, and it's why why I sympathize with Bitcoin investors, because I think that that their hearts are at the right place. You need to protect against the fiat debasement, which is going on right now. I just think they're using the wrong avenue.
Yeah, so that's really, really good to know. We'll watch the dollar, and it's a very bold call because obviously it's a confidence game. So if the dollar's, so you're kind of expecting, and as you kind of should be based on seeing all the foreign investors kind of dumping the dollar, you're expecting a loss of confidence in the dollar, and that would absolutely bring everything crashing down. But my rebuttal or devil's advocate would be, what would people go to? I mean, El Salvador just went to Bitcoin. So what would people go to if not the dollar?
Yeah, I think they would probably go to euros and yen. I mean, currency investors got to be probably in some type of currency. But I think, we're seeing it already too over the last few years, a transition from a lot of central banks, into precious metals. Russian, Turkish, banks have been buying up a ton of gold, although I think Turkey's been selling theirs down lately. But I think a lot of investors and institutional money, I do think the smart money has been buying gold and precious metals. But I think generally, if you have to be in a currency, which is a lot of what currency trading is, if they're selling dollars, they're buying euros and yen. And that's simply because you don't have you wouldn't be having the incredibly aggressive monetary and fiscal policy in the face of inflation in those regions. In Japan and in Europe, are not running fiscal and monetary policy pedal to the metal in the midst of rising inflationary pressures. There's so I mean, it's all relative, right? There's a relative amount of responsibility in those areas that is just not present in the United States today.
Okay, so that makes a lot of sense. So given that potential loss of confidence in the dollar worldwide, there's bubbles everywhere. And speaking as a millennial who's been completely priced out of the real estate market, especially in California, do you think that real estate is a bubble, and is it as vulnerable as stocks?
Real estate is tough. I think that there are some demographic things going on. I mean, your generation coming into their, earning years, higher earning years, and wanting to settle down, start a family, and all that stuff. And the millennial generation is the biggest generation in the country's history. That is, putting a strain on the residential markets. And what's different between today and the housing bubble is that builders aren't responding to that increased demand by increasing supply. And that was really one of the things that created the housing bust in 2009, 10, 11, 12 was home builders saw the massive amount of demand, and they responded to it by building like there's no tomorrow. And so the supply of homes exploded just as demand dropped off. And a lot of the demand that time was also synthetic demand. It wasn't real demand. It was people saying, I'm going to pull out my home equity and leverage that into 5 spec homes. And I saw a ton of that firsthand, in 2005, 6, 7. And so when you have one person who's, should just normally buy one home, buying 5, 6, 7, when that demand goes away at the same time, supply is massively expanded by builders. You get, in 2011, 12, you could buy homes well below replacement value, which was, turned out to be a wonderful investment. Now, the difference this time is the demand. I don't think there's that synthetic demand out there where people are buying, 5, 6, 7 spec homes like they were in 2005. Yeah, there are people buying maybe second homes, vacation homes. There are people buying, investors, buying a lot of homes to rent out because it's too difficult to generate income in the current environment. But I don't think there's that degree of synthetic demand that there was 15 years ago. At the same time, builders are constrained in their ability to meet those demands by increasing supply. They don't have the labor to do it, and the costs of production are copper and lumber prices have gone up so much that it kind of becomes prohibitive to build at a certain price point that can make sense to buyers. And so I'm not bullish on residential real estate from here, but I'm not nearly as bearish, because I think the only way real estate prices would get really hammered is if we had a recession, kind of a stagflationary environment, which I think is probably a distinct possibility, but it would have to be a stagflation environment where economy becomes weak, inflation doesn't really kind of become weak. And the Fed allows interest rates to go up. If the Fed has to allow mortgage rates to go up, I think to really create a bust in the real estate market, because as long as you can borrow at 3%, there's going to be demand for residential.
Okay. And the Fed, you said, can't afford to allow interest rates to go up. So
I don't think so. But there's, at some point they may be forced to allow interest rates to go up.
When the loss of confidence
to protect the currency.
Exactly.
So we'll see.
Gotcha. Great. And you also have an excellent chart on your website, just talking about inflation hedges, right? Because that's what we're talking the risk is. And it's actually comparing the gold price versus 30-year yields, an inverted 30-year yield chart. And the 30-year yield has plummeted, but gold hasn't really moved relative to that. So it does seem kind of like it's in store for a big move. Could you speak a little bit on that?
Yeah, it's actually the chart is probably the thing I watch closer than anything when it comes to the gold price. It's the change in the gold price year over year is very highly correlated to that the real 30-year yield. So that would be the 30-year Treasury yield less core inflation. And when that goes negative, that's usually very, very bullish for gold prices. And today it is. We saw April CPI, came out last month, and like I said, it was hotter than expected. Came in at 3% core CPI, and the 30-year yield's like 2.2, right? And so that means the real 30-year yield is negative 80 basis points, which means that this is essentially the ideal interest rate environment for the gold price. So how do you, and it makes a ton of sense, right? If I'm going to, by definition, lose money in real terms in buying treasuries, long-term treasuries, then what do? Right? I don't want to lock in real, inflation adjusted losses over a long period of time. How do I protect myself? I buy precious metals. And so, what is even more interesting to me about this is that the 30-year yield has come down since I probably published that chart. We're down below 2.2%, and core inflation is expected to come in at 3.4. It comes out tomorrow. If it comes out, at 3.4, and we have 2.2, on the 30-year or less, that's negative 120 basis points on the 30-year yield, which, to me is rocket fuel for the gold price. Based on that, the gold price should be up at least 20% year over year, which, you start looking at that kind of stuff and you go, well, it's not hard to imagine, gold breaking out to new highs and, probably a target around 2,500 an ounce or something like that over the next several months is a distinct possibility.
Great. Yeah, definitely relatively undervalued, especially compared to other assets like stocks. I do wonder if the whole narrative of cryptocurrencies taking a bite out of the gold market could be anything sustainable. I mean, it seems like the Fed wants that to be the case, but do you have any thought on that argument?
Yeah, it has been interesting to see. I mean, like I said, I sympathize, with Bitcoin aficionados. I do think that they understand the problem very well, as anybody. But their potential choice of a solution is flawed, and we can talk about those flaws if you want. But to me, the gold price, when I look at it, this correction in the gold price, a lot of people want to blame popularity in crypto, but it's really just because what we've seen over the last 6 or 9 months is nominal interest rates, right? Bottomed, the 30-year yield bottomed at, under 1% back in March a year ago, and has gone, it's doubled, it's up 100%, since then. Nominal rates go up and inflation has come down, at least into the March number. We were down at like, low ones, 1.4, something like that on core CPI. So that was real rates rising. Real rates rising is bad for the gold price. So the gold price has done exactly what would be expected with real rates rising over the last 6 months. But like I said, that trend is now reversed, and we have inflation rising and interest rates going down. And so that becomes a huge tailwind for the gold price. To me, that explains everything we've seen in gold without even having to consider crypto.
That is an excellent counter narrative to the gold price, because there's a lot of FUD, fear, uncertainty, and doubt in gold because of that. But you're saying, no, it's based on inflation and rates, which is really helpful for investors to know, I think. So then just talking about another call that you've made, which has been amazing, energy. You've been bullish energy. It's doing really well right now. It's actually outperformed over the last month or two, almost everything else. So what is your thought on energy as an inflation hedge, and which components excite you the most?
Yeah, well, to me, one of the things, sentiment is, a fantastic indicator for a lot of these things. When the oil price peaked, back in, I don't know, 10 years ago, the narrative kind of driving the bull market in oil was peak oil, that we're going to literally, the amount of oil, fossil fuels on the earth, that was going to peak. We'd always been kind of in a pattern of discovering more oil and growing oil reserves for a long, long period of time. But the prospect of no longer finding any new oil and then reaching, peak supply was essentially that bullish narrative. But when that narrative became so popular that everybody could say, yeah, peak oil, that was when the price actually peaked and things rolled over. And it turned out that the cheap money delivered by the Fed through the financial crisis allowed this new technology of fracking to come about and created massive new supply in oil. So, but conversely, last year, we saw the opposite narrative, when oil prices bottomed, went negative. But last fall, we saw a lot of people talking about peak demand, that not peak supply in oil, that we were going to see, that we were literally seeing peak demand, and that literally use of fossil fuels was going to peak out and then be in decline for the rest of time. And when you see those narratives become that popular, it's really usually a very good signal of it's time to buy or sell something. And so you also saw ExxonMobil kicked out of the Dow. It was the last remaining original member in the Dow Industrials. They kicked ExxonMobil out. There were so many just signs that there was so much animosity and hate. I mean, the popularity of ESG essentially means, there's so many different ways to interpret ESG. The one commonality among all of them is don't own fossil fuel based companies. And so those stocks have got so cheap last year that, they offered an incredible margin of safety and incredible upside. I think they still do. It's not as attractive as it was back in October, November last year. But, I look at the energy infrastructure stocks. There's a lot of of those companies that are focused on pipelines and terminals and all those kinds of things. And the yields on these stocks is still, 6, 7, 8% compared to 2% on the 30-year. That is essentially a spread that's too wide. Historically, that spread has not been near that wide. And if interest rates are going to stay low, then those infrastructure stocks prices are going to continue to go, way up. And that's been one of my biggest holdings. But I also like the oil and gas producers, because I think those stocks a lot of them are really highly leveraged to the oil price. And they're still very cheap. And I do believe that there is an argument to be made that, oil prices could go back to $100 a barrel. And if so, all these stocks are, it's interesting. It's very similar to a lot of the gold mining stocks right now, where, people look at them like cyclicals. And cyclicals usually look very, very cheap at the top of the cycle, and very, very expensive at the bottom of the cycle, kind of the opposite of what of normal stocks would look like. And that's just because their earnings are so cyclical. And so investors are only willing to pay a low multiple for the energy stocks and the gold miner stocks today because they think they're near peak earnings, that the gold price and the oil price is probably near a peak and going to roll over for some cyclical reason that they believe. Now, if it turns out that that's not true, that the oil price and the gold price are actually going higher, then the valuations of these things have to go much, much higher, because their earnings are going to continue to power higher, and they're not going to continue to trade at such small multiples of those earnings. And so I think, the oil and gas exploration and production sector is still attractive for that reason, because the oil price is probably going to continue to head higher.
Yeah, that's really interesting. So I just love to get your take on kind of what the future is for this space, because obviously you have activist investors like penalizing like Exxon and BP and Dutch Royal Shell just for doing their own business, right? So they have to divest. There's going to be a lot of divestment out of this space. Do you see it kind of being like a situation where, because of all the divestment, there's going to be a bit of a supply crunch where demand will far outstrip the supply of oil? And like you're saying, these kind of infrastructure companies will do really well, even though there's such a push to get away from it?
Yeah, I mean, absolutely. Ironically, the way things work in the capital markets is the more capital going into a sector, the worse the returns are going to be going forward. The more that capital is leaving a sector, the better the returns are. And especially in the commodities world, right? Tons of money goes into a commodity sector. They invest that on expanding production, that boosts supply and results in lower prices. So I think all of this divestment is really well intended for the environment and all these things, but really what it's going to do is just make all of these companies that much more profitable, because it's going to support the underlying commodity. Because the more you take money out of that sector, the more you reduce supply in that sector, the higher the price has to go to meet rising demand. And we're still seeing strong and rising demand for fossil fuels. And so you take away the company's ability to meet that demand with supply, and it could create another energy crisis. You mentioned the 70s. We could see, because of this lack of investment in fossil fuels, we could see another energy crisis with prices screaming higher just as a result of the lack of investment.
Yeah, that's incredible to think about. So you're saying, even though they were going to pump billions and billions into solar and wind, which on this channel we've talked about how flawed that can be, because it's a very intermittent energy supply, and we've proven that all around the world. But so you're saying they're going to pump billions into that. That is not going to be enough to meet the demand of the growing populations around the world. Oil is going to shoot through the roof because of the divestment. And are they going to have to invest into the oil space, or what's the possible end game for that?
Yeah, it's a good question. You have energy crisis, right? That might be the only thing that inspires people to say, okay, we need to work on supplies here. We need to, and that's how the I mean, it's really interesting, right? Every time the government gets involved with these things, they usually compound the problem. And I think, what we're looking at right now with supply chain issues and the ideas to fix them is maybe representative of what we could expect, going forward in these other areas. I mean, you look at like the semiconductor shortage, and the answer that the Biden administration was coming up with, and it's a natural response, is to say, okay, well, we need to reshore production. We need to make semiconductors here. Okay, that's only going to add to the inflationary problems that we're seeing. You might fix that supply chain, but at the same time, you're raising the cost of production. So you're really not fixing a ton. You're creating more available supply, but that supply is much more expensive. So, I think, maybe that's kind of representative of what we could expect in the energy sector too, is something along those lines. And probably the response is going to be, okay, well, we need more, green energy, and that just is going to reduce returns there. But really what they probably need to do, and maybe what they'll do eventually, is to try and reduce demand for fossil fuels by subsidizing, the purchase of, electric vehicles and all these things to a greater degree. The problem, with that is, the production of electric vehicles involves a lot of fossil fuel, burning and mining and all these things too. And the production of the electricity in order to power those vehicles is, a lot of natural gas burning and things too. So there's just no way to solve the problem in the short term, because there, even if you meet those targets about, like, let's say we want 50% of all car sales to be, electric vehicles, by 2030. Well, it still means that the vast majority of cars on the road are combustion engines, still. Even if you say we want 100% of the car sales to be electric vehicles by 2030, which is, impossible, you're still going to have the vast majority of cars on the road are still combustion engine vehicles. And so, and the, majority of electricity generation is still coal and natural gas and these things. And so you're not going to replace fossil fuels anytime soon. And so it's very short-sighted to say we're going to limit these companies' ability, to produce, because it just limits supplies and boosts prices. So it's an interesting problem.
Absolutely. So my last question will be just about uranium, because a lot of uranium bugs will say their only option to have this baseload power source is to increase their nuclear output. Does that make you bullish on uranium because it is technically a green energy?
So, that's a great question. For me, uranium meets, the macro probably standard, that I would use for that type of an investment, but it doesn't meet a lot of the other standards. So I try and find things that are cheap, out of favor. So fundamentals, sentiment, technicals, macro, all those things I want working together. And for me, a fundamental confirmation for a lot of the work that I do, one of the things that actually drew me to energy last fall was the insider buying in the sector. I saw mass executives just stepping up and buying a massive amount of their own stock in, Harold Hamm, for example, CEO founder of Continental Resources, was buying, 20, 30, 40, $50 million slugs of his own stock. And to me, that's confirmation that, okay, not only is it cheap, he believes it's cheap, and he's putting his money where his mouth is. That to me is the type of confirmation I look to validate a thesis. And so uranium honestly just hasn't crossed my radar in that respect, where I've found something that is cheap enough, validated by, insider buying, and, meets those other things. And, I've said to some of my readers, maybe that's a shortcoming of my own process, that it hasn't hit my radar. But that, that's the reality of my process and what it turns up and sometimes doesn't turn up.
No, that's fair. And there's plenty of other good asymmetric plays, so you don't need to get them all. Anyway, so thank you so much. Where can people go to learn more from you?
Like I said at the open, I'm pretty active on Twitter. I do a ton of reading in the mornings, and I try and share what I find of interest there. It's just at Jesse Felder, and then I try and put up a weekly blog post, or on occasion a podcast of my own at thefelderreport.com.
This discussion is for informational purposes only. Nothing in this discussion should be taken as investment advice. Guests are not compensated for their appearance. Do not base any investment decisions on the information presented.